Hello everyone, this is Christina and welcome to our Scientific Forex live webinar. It's a pleasure to see you all here with me. Before I continue, please tell me if you can all hear me. You can type it onto the chat box on the webinar control panel. It's found at the right corner of your screen. Also, if you'd like to ask a question, you can also type it into the chat box. For general questions, I suggest for you to wait until near the end of the webinar because I may be able to include the topic during the webinar. If your question is specific to the topic being discussed, or if it is asking about one of my examples, just type in your question and I will answer it to the best of my knowledge. We will also have a question and answer session at the end of the webinar. This session is being recorded and will be posted in the members area for you to review and download. Our team is standing by, so if you need any help and want to chat personally, just let me know. Go to the support section in the members area and call us, send us an email, or use Skype or live chat. We are here for you. So, today in our webinar, we will talk about fundamental analysis and actually what it is about. Most of the financial institutions are making both technical analysis and also fundamental analysis. So what is about that fundamentals? Actually, all are related with the risks that are involved when we talk about one currency or about one pair that we are that we want to trade. All the things that we have in our portfolio can be at risk. So, for this reason, we have to make the analysis of the risk that we can face when we are trading. This fundamental analysis is actually a way we have to find to quantify the risk involved. And for this, actually, we have to know what we are facing in financial market as a risk. So, risks are defined as losses associated to negative evolution of results. Risk is a term often used to imply downside risk, meaning the uncertainty of a return and the potential for financial loss. Measurements of risk are the measurements of those negative results and their influence on our profit. In financial market, we have assets and liabilities management as a central problem, or in other words, the fundamental analysis. So we can identify the following types of risk. We can have financial risk, we can have operational risk, we have some types of business risk, and also accidental risk. So I will talk shortly about all those things, and I will go on detail on the risk that we have to take care about when we receive one message regarding one release from different organization. So the first types of risk are that we have to quantify are financial risk. So in those types of risk, we have to look about the structure of commercial balance. That means for currency about we have to see what is the quantity of exchanges, what is the trade balance, if it is increased or if it is smaller. This is giving us a good idea about the volume of the currency that is possible to be traded. A next thing that we have to look about is the structure of declaration of inputs and exits. This is more for one financial institution, but also we can look for currency at the structure of loans that the country is making in the financial market. A next type of risk that can make a difference in for the value of a currency is the proportion of capital. Actually, most of the country use one type of rollover of the credit. So if they are coming in the market and they are asking for big amounts of money because they need to roll over one debt that they have, it is possible not to find in the market that amount. So in this case, it is possible that currency to be more expensive, and on the charts we will see that the value of that currency will decrease. One other risk is the credit. Probably you already read a lot of articles about the financial problems in Greece, or also there was some problems in Ireland and in Iceland because of the credit. Actually, when one economy is worsening, it is possible we have the possibility not to receive any credit for rollover of the capital, but also it is some possibility that that credit not to be paid back. So that can be some very important risk for one investor. all the financial companies are looking to this, because if this will establish the value of the credit. Actually, if you, as investor, you are going to buy some bonds that are issued for 30 years, can be a problem, because there are a lot of things that are happening during 30 years. But if you are buying some bonds just for 6 months or 1 year, a short term, it's possible to receive all your money back, the principal and also the interest. So we can see some difference between the cost of credit for different areas, for different economies, and we can see also that there are countries and economies that are not able to pay back the credit. So we have to quantify this type of risk also and to think about. One other problem of risk is the liquidity. Actually, in this period, we have one crisis of liquidity, because probably you notice in your in most of the countries there are not so many liquidities for financing different business. So this can be a crisis of liquidity and can make problems. As long as a business cannot be financed, the economy will go down. So in this case, the currency will become weaker. One other type of risk is the risk of the market. We have actually those types of risk are speculative risk, as are classified by Bank of International Settlement. If we have pure financial risk like liquidity, credit, or solvability, we have also speculative risk. Those are risks that are coming from financial arbitrage, from the exchange of the currency into the market. Those types of risk from financial arbitrage are coming from the difference of taxes, from the variation of the currency, or from the value onto the market. Maybe there are some strange things or not too much familiar for you, but when we will talk in details about those types of risk, you will know what you have to look when you are looking for fundamental analysis, and you will understand what are the influence of the changes that are made by big financial institutions like retirement funds or governments or banks or, I don't know, central banks, and why those decisions are making influences in the market. As you already know, in the market we have to make technical analysis and fundamental analysis. If we are stopping just to the technical analysis, we should see on the charts just perfect swing between some values. But you know very well that those things and those variation of the pairs between different levels are made also when we have some releases regarding I don't know, regarding the rate of interest, regarding one decision from one central bank, regarding when we have one decision regarding the tax that is legalized into one country. Also, we have different strong swings and different strong moves when we have macroeconomic releases like unemployment rates, like trade balance, or like CPI. Yes, we know we are talking about inflation that can occur in one country. The financial institutions also are looking to the operational risk. So also those types of news regarding the big financial institution can make some difference in accuracy. We can talk about internal fraud, external fraud. I will give you some examples. Probably you already know Madoff case. When they presented the Madoff case, the financial market had some problems, and the first tendency of the market was to have to protect the portfolios. One other example is the case of the president of the Switzerland Central Bank. It was probably, I don't know, maybe you know the story. His wife was trading the intervention of the central of the Switzerland Central Bank into the market to have a weaker currency in Switzerland. One other problem is the security of working place. Actually, the security of working place is quantified in different ways when we are in one financial business. We can talk about the security of the bank, or the security of the funds or the physical assets that we have as deposits and so on, or we can talk about the securities, different types of security that we have in one country where there are the population is restless or it is war or things like this. Some other types of risk that are involved are the risk of the clients, the risk of products, the risk of services. Related to this, we can think about the problems that it is possible that the clients have to when they are using the financial market. Actually, we are not talking about the forex market here related to the clients, because there are not so many private clients that are acting directly. Let's say they are not buying bonds, and they are not all the time dealing with those financial markets. But it can be some types of problems when we are talking about medium business or big business that are also making security for the financial assets that they have. It is possible that in one crisis of liquidity, the clients to go with all those products into the market, and they start to sell before the maturity all those financial instruments. They can sell all the bonds that they have, they can sell T-notes and so on. So in this case we can have some types of violent moves onto the market. Actually, those types of moves we can see better in the gold market or in the commodity market, also in the stock market, not really in Forex, because Forex is a very big market, and those clients don't have the power to modify the variation of the pairs. Another type of risk are the loss of physical assets and the execution, delivery of or management. Those are some types of risk that so in this case we are talking about the loss of physical assets. We are talking about the loss of some physical things that are into the treasury of different banks, but those risks are very small in those days. It's not possible to be lost so easy, the physical assets, but also it can happen, can occur. And the last type of risk regarding the execution, delivery of management, we can have some not so good type of management in especially in some of the central banks. Or, of course, we talk about the execution of one decision of one central bank. And this can make one difference in the Forex market. The next types of risk is the business risk. And for the Forex market, we are talking about macro policy. probably you already noticed that in most of the country we have 2 or 3 parties, and they are proposing different types of economic policy. So in this case, we can have types of macro policy. In the developed countries, those changes are not so big, but in the rest of the country can be a big difference. If you are thinking at the countries in the Latin America, in the last decade, in the last, I don't know, 30, 40 years, we had a lot of change on that area. So when they are passing from one type of state to another, we can have a lot of changes in the economic policy. So this can make a big difference into the market. I will mention maybe the 1970 period, when most of the countries goes to for at least social government, socialist government, so they changed the way of operating in the business and with taxes and everything. Actually, when we have those big changes in macro policy, we can see those cases when the countries are defaulting, like we have the default in Argentina, and also in the last years we have a lot of changes in Chile. There was very big changes in Cuba when Castro came onto the power. So actually those are the big moves, and they are very violent in the financial market related to macro policy. But also we can see changes in financial market when we have let's say like we have in the United States when Obama comes onto the power, and he have one very important point in his campaign regarding the health security and the change that he wants to make related to protection of the population. So after the election took place, the market have the reaction. One other type of risk in business, in financial business, is the financial infrastructure. I don't know, there are different types of countries where are not yet implemented all the financial instruments that we have in the developed countries. There are countries, let's say in We have some countries maybe on the old CSE, in the old Russia, where we don't have cards. So the payment with cards, with Visa card or with MasterCard, is one type of payment that is bringing liquidity in the market. We don't have in some areas the possibility to pay online or something like this. So we can talk when we are trading those types of, when we are trading those currency, we have to consider those things because the liquidity is a problem in Forex market. So if we don't have the financial infrastructure, can be a problem for the financial business. Another thing is the legal infrastructure and legal responsibility. When we have to consider those types of risk, we have to think about the regulation in the countries. There are countries where we don't have, where we have strong regulation, and there are countries where we don't have such a strong regulation regarding those financial markets. If you are thinking to one example of those things, I can give you the regulation that we have in the United States regarding the leverage that we can have in the financial market, and about the proposal that they have to put the maximum leverage to the at 1 to 50. So that can also be a problem related to liquidity in the market, because when you have a smaller leverage, you have smaller quantities to go to open one position. Also, there are different types of legal infrastructure, may be related to the tax that you have to pay for the financial, when you are making financial operation, when you have one financial business, even if it is a small one. The legal responsibility is a different type of risk, because you can go into one market to, I don't know, to buy T-bonds, for example. When you are buying T-bonds, it means that you are financing the government of that country. So if they are giving the guarantee to be paid back all the principal, you have less risk. If they have just free variation, if they let free the variation of the financial instruments, it means that you have bigger risk. So something like this is the legal responsibility. Or let's say you have T-bonds not from the government, you have T-bonds from one town or from one mayoralty. You are financing one town, but in that town maybe because of the regulation, the economy is going down. So the community will not be able to pay back the principal of that T-bonds because if the economy is down, they are not collecting taxes, and in this case, there are not the chance to pay back the interest or the principal of those T-bonds. I have in my mind the example of Detroit. Probably you know that in 2008, in Detroit was very big problems because the auto industry was down. So there was a lot of persons that lost their jobs. When they lost their jobs, so the government lost the taxes that they was paying from the income. Also, they was not when they lost their job, they have no power to pay the credits that they made. There was a lot of financial companies that was also broke. So also those companies wasn't able to pay taxes. When the taxes are not paid, everything in that area is going down. So also the infrastructure offered by the state, the streets, the firemen, the cleaning companies, I don't know. Everything is going down, and everything is difficult to be kept alive. So also the loans that the community made by issuing different types of bonds, treasury bonds, T-bonds, was not paid, so the person that invests into that bond make losses too on their profits. So that can be, this can be a type of risk. About reputation, this is a very sensitive thing in financial business, because actually you are using the services of one financial company as long as you are trusting in that company. When you are not trusting in that company, you will prefer one other that is more secure for you. So reputation is a very important aspect, and all the financial institutions are looking to keep the reputation as clean as possible. I have one example regarding the Société Générale. In the last period, when Moody's downgraded a few European banks, first on the list was Société Générale. So because they put too much money in the Greek bonds, so as soon as it was one gossip in the market that the Greeks will not cover the principal of the credit that they made. They will not pay back the money that they took from the market. The value of the shares of Société Générale was down in a very violent way. Also, the euro was down because financial markets, when they think that on the financial market the banks are not taking good decisions, a lot of persons think that it is possible to lose their money, so probably they act and protect what they have as investment, as portfolio. The last risk of these types of risk is the country risk. And actually we have several agencies like Moody's or Fitch or Standard & Poor's that are making from time to time analysis of the countries, and we have quotation for the economy of those countries and recommendation for investment in the financial instruments that those countries are proposing. Probably you remember how nervous was the market when United States was downgraded, when United States lost the AAA rating. Why is important this type when we have those types of announcement, the markets start to be very nervous because the big financial companies have in their prospect different rules that they have to respect. Actually, can be one rule like this. They really invest the money of their clients just in countries that have AAA rating. When the country is losing that rate, they have to sell. So that brings in the market a lot of variation of currencies. The last type of risk that we have to talk are the accidental risk. There are political risk, like changing one type of government in force, not in a normal way with election. We have the contagion risk. It means we have the financial market very well connected, so as all persons, the financial company are splitting the risk between investing in different types of assets. So when they have a lot of things in their portfolio, if one point of the portfolio is not so good, also they can have risk. Actually, is when the economy of Greeks was going down, a lot of banks start to have bad financial results because of that fact, it was contagion risk. Other type of risk can be banking crisis. Here we can talk about the credit crisis that is just slowing the economy, and we can talk about the default or bankruptcy when the financial institutions are not able to pay back, are not able to honor the obligation that they took. They cannot pay back the money that they lent. And the last one, exogenous, there are different type of accidents that are coming, like I don't know, somebody is stealing some big amounts from the bank, or there are natural catastrophe that can make some influences because the business cannot develop as was projected. Okay, before I will start to talk about first type of risk, first type of financial risk, if you have any questions. Andrew. Besides Forex Factory, for news reports and any other site, you recommended to view more of the country's economy news in detail? Actually, you can go on the site of BIS, the Bank of International Settlement. You also can go to the sites of the central banks. You also have Reuters and Bloomberg for different type of news. And you can also check SIA sites, because they also have a lot of economic reports regarding different countries, and they are well informed. Okay, so I saw that we don't have too many questions. Actually, I want just to be aware regarding the risk that can change the variation of one currency, because as I told you, in the Forex market we have retail and we have the big financial companies that are acting. If we are talking about retail, we will think at technical analysis. We will think about a lot of traders like us that are going into the market and going to trades according with the indicators and with the trends of the market and with the levels of resistance and support. But also we have those big financial institutions that are in the Forex market. If retail is maybe 30% of the market, but I'm not sure. Maybe it's a very big percent for retail. The rest of the forex market is for financial institutions. Those financial institutions are acting on bigger time frames. I'm thinking of minimum 4 days, minimum 4 hour time frames, but most of them are acting on basis on analysis they are making on daily, weekly, or monthly. So when they are going into one position into the market, they are looking for both for technical analysis on those big time frames and also for fundamental analysis. So what they are looking when they are making the fundamental analysis, they are looking at those types of risk, and they want to quantify the risk, and they want to anticipate based on history what can be the change in the variation of the currency if one of those types of risks occur. Actually, the financial business is related to the risk. We can quantify those risks in the complicated way, but we have to know as much as possible what will be the future of a currency, anticipating those fundamental risks, those financial risks, those political risks, those operational risk, or we quantify for a short period the risk, and we manage them with money management. So if we are going in the market with small amounts of money, we are going to look for the variation of the pairs on smaller time frames. So we want to see the big picture on daily. What is the situation in that country? What is the trend of the relation between commercial relation between those countries? When we are trading one pair, it means that we are looking to those two countries where that currency is acting. So we are looking on daily, and we are going on 4 hour or smaller time frames. So in this case, we don't have enough time to make one strong analysis like a fundamental one, because actually for time frames like 5 minutes or 15 minutes, don't matter what is the fundamental analysis. We have just to look to technical analysis. We have to look to the indicators. We have to look to the trend. We have to look to the volume of the market, and we have to check for the levels of resistances and support, and we have to go, and we are making the trade. So in this case, it's more important the money management, and it's more important to respect those rules for money management that are based on probability. If we are going with bigger amounts of money. We want to be protected, and we also want to know more about fundamental risk, and we have to consider all those types of risk that we have into financial market. So we will start to calculate is one specific way to anticipate all those risks, and is one specific way how we have to take in consideration of those fundamental changes. And we have to make one scoreboard for the currency where we put all those risks that we calculate, and we have to have some values of variation, and we have some targets. We will not talk about those things in those webinars. I will not try to transform all of you in bankers or so. I just want to know why the swings and the swings of the currency of the pairs are not perfect. And I want you to know why we have to look of those releases, and how big can be one change when we have one big transformation into one market. The first things that I will talk, and maybe we will have a few minutes for this, are the financial risk. And today I will talk to you just a few lines about pure financial risk. So the first one is the credit risk. What is credit risk? Credit risk is an investor risk of loss arising from a borrower who does not make payments as promised. Such an event is called default. Investor losses included the principal and the interest. Those losses can arise in a number of circumstances, like a consumer does not make a payment due on a mortgage loan, a credit card, line of credit, or some other type of loan. A business does not make a payment due a mortgage, credit card, or line of credit, something like this. When a business or a consumer does not pay a trade invoice, or when the employees are not paid, or as I already talked with you in the first part, when we talk about Detroit, when a business or a government bond issuer does not make a payment on a coupon or principal payment when due, So this is the situation of Detroit, or actually was the situation of the Greece in the last period. So actually, when we are talking about the credit risk, we are talking about some bad events that occurs, and one loan is not paid. Also, you can think about one insolvent insurance company, or one insolvent bank, or government grants bankruptcy, protection to an insolvent consumer or business. A special part of those risks is the sovereign risk, and this is what we face in Europe, where the government made a lot of loans from the market, from the financial market, and now they are trying to roll over. Why? Actually, the sovereign debts are at maturity, most of them, and because of the welfare state, the debts are not, countries are not able to pay in time or to cover all those promises that they make to the investors. Something like this is not a happy situation, but this is happening. So what is the sovereign risk? Sovereign risk is the risk of a government becoming unwilling or unable to meet its loan obligation. Earlier I talked about the situation of Iceland. Actually, Iceland refused to pay the loans that they took from the financial market, and Iceland as a country was have to go to the court and was obliged to pay all those debts that they made. Iceland is not a big country. They have about 300,000 persons living there. The debt was not big, but the situation was something very strange in our times, as long as they make one loan and they don't want to pay it. Many countries have faced sovereign risk in late 2000, when we have the global recession. The existence of such risk means that creditors should take a two-stage decision process when deciding to lend to a firm based in a foreign country. Firstly, one should consider the sovereign risk quality of the country. If the country is covering the loan, probably nobody wants to invest in Greece now. This is what we are referring when we are talking about sovereign risk quality of a country. and then consider the firm's credit quality. So if you want to take, let's say, you want to put in your portfolio some shares from Vodafone. From Vodafone Greece. Vodafone Greece is one company acting in Greece and is based on Vodafone activity is based on the situation that is on Greece. Actually, if you are going deeper on your decision to acquire for your portfolio some shares from Vodafone Greece, you will look to the Greece, what is the situation, and you will look at the company. When you are looking to the country, you will know that the economic is not working so well. You will know that the government is not respecting their obligation. In this case, the company or the state employees will not be able to pay in the due time the obligation for utilities and so on. So it is a possibility that that company have some losses if the clients are not paying in time. But when you are looking at the company, you will saw that the majority of the shares in that company is kept by the Germans. Germany is a good country. They will respect all their obligations. So if you are acquiring shares from Vodafone Greece, you will consider this. Also, you will consider that they will pay in time all those obligations that they have. So you have to put all those things together when you are deciding for your portfolio. Even if it is in the forex market or if it is in the stock market. There are 5 macroeconomic variables that affect the probability of sovereign debt, and those things are debt service ratio, import ratio, investment ratio, variance of export revenue. These are related with taxes for export and for the rate of exchange, and domestic money supply growth. Domestic money supply growth is related to inflation with CPI, with consumer price index. Another financial risk is counterparty risk. This is so we have credit risk, we have sovereign debt risk. Counterparty risk is another part of the credit risk. Counterparty risk is known as default risk. It is the risk that an organization does not pay out on a bond, credit derivative, trade credit insurance like American Insurance Group, those problems that they have with covering the insurance for swaps, or payment protection insurance contract probably you know that financial market also is related with the insurance market. And actually, the insurance market is born because all those types of risk that occurs in financial market need to be covered somehow. We have those insurance companies. For probably most usual for you is insurance health company, but also if we want to keep the health in financial system, we have to use those insurance companies for different types of risk that we have in financial market, like default, like credit risk, like solvability or liquidity in the market. Also payment protection insurance for contract is covering the risk of not be paid by the client. But those types of protection is for big companies, not for the small companies. If an organization who think that they have hedged their bets by buying credit insurance of some sort, still face the risk that the insurer will be unable to pay, either due temporary liquidity issue or longer-term systemic issue. So, in 2008, when Lehman Brothers default, there are a lot of swap problems that was not covered by insurance companies. Also, in Ireland, when they default, when they don't want to pay their credit, they cannot be covered by the insurance company. So the creditors have to go into the court against them, and the payment was delayed. But of course, all delayments are meaning something in money. Large insurers are counterparties to many transactions, and thus this is the kind of risk that prompts financial regulators to act. This is why we have the bailout of the issuers of those insurance, like we have the bailout of AIG. So sometimes maybe it's better to know about those things, but sometimes it's enough just to know the things that if we have one news regarding something bad that occurs, there are several. It's not necessary to take decision right in the moment. We can wait to see if the insurer will have one decision to delay the payment, to pay, to cover that risk, to delay that payment, or not pay. So actually, this is why we have variation in the euro-dollar now. The regulators don't take all the decision related, covering all those risks that occurs in sovereign debt in Europe. So as long as we don't have what is their decision, we cannot talk about I don't know, a big drop in on euro dollar, a violent move or something like this. Okay. I will stop here with the risk of the financial market. I will stop here with the financial risk, and we will continue in the next webinar with some specific announcement and settlement and how they are influencing the markets, especially on smaller time frames. If you have any question, please. With all the things you have considered, like technical and fundamental analysis, how to avoid over analyzation of charts or analysis by paralysis does put you in a position to trade or not to trade. So for us as retail traders, it's very simple. We make the technical, so we my personal view, I think that the traders are split into retail traders, those ones that are going into the market, I don't know, the biggest amount maybe a few million equity. And there are the big financial companies. When we are talking about the retail traders, we are talking about traders that are going on trades based on smaller time frames. The biggest one, 4-hour time frame. So if you want to have a nice profit from this business, you have to be something like very active on the market to open some position, to take the impulse and to take the correction from the market, and to have to take all those opportunities that appears in the market. In this case, you are making technical analysis basis on the indicators, and you are making the money management. You have to construct your money management according with the leverage that you are allowed, according with the money that you have in your account, according of the type of platform that broker is offering to you, according with the spread and the commission that you have to pay to the broker when you are trading one pair on that platform, and according with the taxes for the income taxes that you have to pay as long as you are in most of the country we have to pay those types of taxes for income that we are making like a private investors. So in this case you are going, maybe you are looking at daily to see what is the situation of that currency. A trend on daily means several months. You don't have to stay several months in one trade. You have to go for trades on 4 hours. That means 1 to 3 days up to maybe 1 or 2 weeks maximum. For the person that have a daily job and do this just to have some extra incomes. You can go on daily basis and work with 4 hour and 1 hour time frames and look for signals on smaller time frames. Let's say you are working with 4 hour time frames and looking for signals on smaller time frames like 30 minutes or 15 minutes. Or you are working just a few hours every day and you are going with to look the trends and resistance and support levels on 1 hour chart and look for entries and exits on 15 minutes charts or 5 minutes charts. So this is the small business. This is what we have. This is what we have as retail traders. If we are talking with the big business, the big financial market, we are talking about the hedge fund, those ones that are offering insurance for different types of business, especially for export business. We are talking about the insurance companies, we are talking about the retirement funds, we are talking about governmental agencies that are coming into financial market to borrow money. Those types of investors, the big investors, will make also those fundamental analysis because they are coming into the market with signals that they are receiving in 4 hour chart or on daily. What is 5 minutes chart for us is 4 hour chart for them. So in this case, they are staying in the market. When they are opening one position, they are staying in the market minimum few months, 3 months, 6 months, maybe 1 year. So why it is important for us also to know fundamental analysis is important because when it is one release from statistical organization, statistical departments from different countries or different banks or so on, when we have one statement from the central banks, when we have some information about the change of law like we have in Europe when European decide to ban the shares of the banks. You was not able to sell any shares of the bank that you have in your portfolio for a period of time. So was something that uh, was a very bad thing for the value of portfolio of the small investment companies or for the investors that have shares from different banks. So when appear one statement or one release, one political statement or one release from one statistical department of one governmental organization, when it appears one modification of the grade of a country of one of or one or of one big company that make difference in one country's economy, like AIG, yes, American Insurance, or when they are downgrading one auto company, or when it was problem like Elron, for Elron when the shares went down, or the shares of Bank of America went down. We have to be precautious because investors take action, and actually it's something very bad when one big company like Bank of America is going in a bad situation, because probably you know the rollover of the Bank of America is bigger than the GDP of a lot of countries. So of course that Bank of America will have a different influence in the market than will have a small country with GDP smaller, or maybe 10% of from the rollover of the Bank of America, or from the Citibank or something like this. They are important. They are moving a lot of quantity of money. So those decisions, when those statements appears, when those gossip appears in the market, the investor take action to protect the portfolio. So also we, the small traders, we have different things that we have to take care in our portfolio, and we have to protect our position. But as long we have the money management based on probabilities theory, we are okay. So we will go into trades. We don't have to make all those analysis. We just have to understand what means something like, I don't know, something like this, something like news, and why the market is moving. Clive, Forex Livecom is a very good free service for what's happening in the market. Actually, I will try. I don't know about them. Geoff, put to me one question. Understandability, everything you've noted tonight has significant importance. However, is there any way to simplify the decision based on looking all those things? As in Can it all tiger somehow to make a quick decision? Um, Actually, I had a lot of questions about the time frames that I'm recommending. So I want you to know that if you are going on, you make the analysis on daily charts, on daily time frame, and also on 4 hour. But I not recommending to go into trades on, I don't know, weekly, daily, or weekly time frames. They are too big and is a different way of acting when you are trading, when you are opening one position for a long time. For us, it's very important to go on 4-hour charts because, as you know, we have a lot of backtests for indicators, and the results from those backtests give us the best accuracy for our charts for the most of the indicators. Also, you have the money management and the risk-reward ratio that give you some safety when you are going into one position. Also, it is important to know that bad things is happening all the time. We will never be protected from everything. So when you are making trades, also you have to accept that some of your trades will be losses, not everything. You will not have all the time just wins. Maybe you are gonna have a good rate of winning trades, but you have no chance to be covered for all those risks that are coming from outside of us. So actually, this is why I'm talking about those things, about fundamentals, just to understand the market and as like a psychological help to accept the stop loss and to accept that also you will have losses into the trades. But if you are remembering that 1 to 3 risk-reward ratio allowed you to have just a few trades on positive. So if you are applying this, it will be okay to have also a few losses, because the winning trades will be all the time covering those losses. In the next webinar, I will talk about those macroeconomic things that are moving the market. We have those risks that are coming from the financial system, risk of interest, risk of regulation, risk of liquidity, risk of solvability. And also we have those macroeconomics risk that we will talk, and in the next webinar you also will see into the chart how those things are acting. Stuart asked me, do you have summarized risk analysis for the countries you trade in? I have a scoreboard just for a few currency, but is related to other things. In the market, in the forex market, I'm avoiding the period of releases because the traders are acting chaotic. Dagmar, real-time graphs, I don't think that I will have the opportunity to have one change of the I don't think that I will have the opportunity when a central bank will change the interest rate to show it on real time. But I will show on the history some of these things. Milan. So there are too many conflicting factors. Yes, there are a lot of conflicting factors, and just we have to know, we have to understand a part of the economy of the country of which currency we are trading. How to handle such a situation from a retail trader point of view? You have, if you are beginner, you don't have a system to trade the news. You just have to base on technical analysis and on money management, and avoid to stay when there are important releases. I will go through Forex Factory site in the next webinar, and we will talk about those things. Today, I don't think that we will have time to go on the charts. Okay, so thank you for your time, and I will wait you in the next webinar.